Legacy to me is the ultimate measure of whether or not you've succeeded. Did you create generational wealth? That is winning in business. My main goal is to just develop a relationship in person with the people we serve. So we have clients literally all across the country, all different businesses, 18 different industries, and that's what we gave the attendees. This is a true mastermind.
The amount of knowledge, it's almost hard to keep up with, but it's super interesting if you really care about protecting your assets and developing the legacy.
UpLevel is your resource for that. Whether that's UpLevel University, whether that's UpLevel Protege, whether that's UpLevel Elite. We have a variety of different programs.
It was the best financial decision that we as a company have ever made. When you come to the event and you listen in person, Ed was very passionate. It's very contagious, so it gives you the desire to actually take your step and move forward.
We create this ecosystem where you can actually have conversations that are candid and raw and real.
Edward is building this community. Seems to be very special. He genuinely wants you to succeed.
Genuine person who's honest and extremely knowledgeable.
My experience is transformational.
But seriously, Edward's team is amazing. Whatever they say, they are always right.
100%, I'm an unapologetic capitalist.
Unapologetic capitalist, and quite frankly, hopefully you are too. Otherwise, why are you here, right? You're spending a bit of your own free time to be watching this, to be hopefully gaining some information to take your life and your overall financial situation to a better level. But quite frankly, if you're not a capitalist, this is not going to be the right fit for you. See, the reality is that capitalism is probably one of the most amazing systems that has ever been created. Now, granted, there are a lot of challenges with it, right? But compared to everything else in the world, it is the one ecosystem that actually creates the opportunity for everyone that is participating to actually be better off for it, right? Because the concept of capitalism is that two or more parties are coming together and they are exchanging basically for the purpose of increasing the value that they receive in the process of the exchange, right? So if I go out and I buy a phone from Apple and I give them, let's say, $1,000 of my dollars, well, Apple is interested in giving me the phone because from their perspective, the phone is worth less to them than the $1,000 that I'm giving them. And from my perspective, the phone is worth more than the $1,000 I'm giving them, right? So both of us come into that ecosystem because we believe we are bettered for having engaged in that exchange. That's the concepts behind capitalism. And if you are a high-income W-2 professional, well, in the grand scheme of things, if you're not really in the know with regard to how the system works, with regard to the rules of the game, you're going to continue to be getting the short end of the stick. You see, the purpose of this session is to give you an opportunity to understand how high-income W-2 professionals can keep more and pay less. So the goal of today is really to figure out how to stop feeding the IRS and start building real wealth. Now, if you're frustrated that you keep writing these stupid checks and sending them off to the IRS, you're in the right place, right? Because you're not alone, right? The concept of a W-2 professional, what you have to deal with is that you're earning a lot of money, but unfortunately, so many W-2 professionals that I know, they were hoping that their CPA was handling it for them, right? But if that's the case for you, you're playing the wrong game. You see, this session is about taking back control of your money, your structure, and your future. But let's make one thing clear. This isn't about a tax evasion play. There's a lot of ridiculousness that goes around social media these days, right? A lot of horrible concepts that are being shared out to the public. That's probably one of the ways that you came into my ecosystem in the first place. You probably saw one of my reaction videos. If that's the case, let me know in the comments right now. Like, if you're watching this live, drop it in the chat. Have you seen my reaction videos? Say yes if you have. If this is something you're watching on the replay, a video after this live session is over, drop it in the comments. Let me know. Are you seeing my reaction videos? And if so, hopefully it's resonating with you, right? Because there's a lot of ridiculousness out there. In fact, the whole motivation for me to jump into social media in the first place was because I got really, really frustrated with the stupidity that was being bantered around social media. And I don't want individuals to fall victim of scams and evasion schemes, but unfortunately so many are. And I can't tell you, over the course of the past nearly 30 years of me doing this, I've run into situations where individuals have been really targeted by, unfortunately, some unscrupulous human beings that were trying to pitch concepts and sell ideas that, quite frankly, got them in trouble, got the individuals that came into our ecosystem, got them in trouble, so we had to fix it, right? We had to sort of like unwind the challenges that they got themselves into. So I jumped into social media in order to help elevate financial literacy out there, because here's the thing, guys. I hate the government. I'm very vocal about it. I wear it on my shirt sleeve, right? I hate the government. I love America, though. I think America's the most amazing country in the world. It's just that I believe the government to be corrupt. I think that taxation is not theft, it's extortion, because the IRS has guns, right? That's my position, right? I lay it out there because I think it's important for you to understand my biases if you're going to listen to the words that are coming out of my mouth, right? Because at the end of the day, those words are influenced by my bias, right? So I want to share with you what my bias is so you can sort of filter what it is that I'm saying and understand the perspective from which it is coming so that you can use your brain and figure out what you want to do with the information that I share. And today is not about tax evasion. Today is about tax strategy. It's the kind of strategy that the wealthy have been using legally for decades. Are you guys interested in jumping in and figuring out how to take it to the next level? Let me know in the chat. Let me know. Again, this is I think our third YouTube live. So we're still trying to figure out all the ins and outs of how this ecosystem operates. But my team has set it up so that I can see a chat over here. So if you're interacting, that helps me, right? Because it lets me know that the world is not quiet out there. Now, I also know that a lot of people on YouTube may be watching this on their actual televisions. YouTube is like making a huge push into the TV ecosystem. You also may be watching on your mobile phones, and it may be difficult to use your thumbs to type in the chat. But if you can interact, I get a lot of value out of that. And if you ask questions in the chat, I will make attempts throughout our time together today to jump in and try to respond to some of those. I also know that some of my team members are going to be jumping in and out of the chat as well, so they may be able to give you some guidance as well. Now, if you're watching this on the replay, still don't be shy. Jump into the comments section and go ahead and ask your questions there and drop your perspectives there, because again, I'll be jumping in. So from time to time, I may be able to reach back out to you and give you some more insights and information and just banter back and forth. So that's what this whole thing is about, right? It's called social media. So let's be social with one another. Fair enough? Fair enough. Gia is asking, what are you considering high income, high earner? Well, a lot of different individuals have different perspectives on this. I'm looking at individuals who are YouTube live. Oh, what is that? I'm hearing audio. Oh, my team is doing funny stuff behind the scenes with me. So either way, hopefully you can hear me. Let me know in the chat. Can you hear me okay? Yes? No? Maybe so? I heard some audio come back through me. Okay, that was Hector back in the sound room. Hector's running the whole run of show, making sure things are going great. Andres, thank you. We can hear you. Awesome. Very, very good. Well, a high income earner, from my perspective, is someone probably in that mid six-figure range, like 250 and above, from an earning standpoint, tends to be in the high income professional category. And the reasons for that is because once you hit that $250,000, $300,000 mark, you start paying, well, you're always paying stupid taxes, but you start paying really stupid taxes, right? If you don't have the right strategies in place. So that's typically where I'm focused. Like if I'm going to be talking with high income professionals, W-2 professionals, I'm typically talking to those individuals who are earning a few six figures, if you will, if not higher. And they're getting that gut punch every year when they realize how much they're given over to their least favorite Uncle Sam. So that's what I'm talking about when I'm talking about high income W-2 professional. And I want you to keep more, pay less, and ultimately stop feeding the IRS and start building real wealth. Right here in our ecosystem, I focus on helping high income business owners, W-2 professionals, real estate investors create what I refer to as generational wealth. Right. So when you look at all the different measures of success in life and in business, I believe the creation of generational wealth is the key marker. That's the epitome, if you will, to know that you've hit a significant milestone of success, because it means you've done all the other things right. You've learned how to keep more of every single dollar you make. You learned how to put those dollars to work in order to create even more wealth. You're protecting it all with the right infrastructure so that all the enemies at the gate are kept at the gate, right? They can't get in and get your stuff, the creditors, the litigants, the opportunists. And then ultimately you're building real legacy. You have a plan in place to ensure that what you're working hard to create is ultimately going to the people and the causes you care about. That's what I focus on, right? I'm a lawyer. I specialize in tax, estate, and business law, but I'm also a serial entrepreneur. I own multiple companies, mostly in the financial space, right? I own a private wealth management firm. I own an accounting firm. I own a fractional CFO company. I own a tax prep firm. Plus our real estate portfolio, residential and commercial real estate. And I'm saying all of this not to be braggadocious, right? I'm telling you this because I want you to understand that I'm academically trained in the languages of business and money, and I have real world experience putting that knowledge to work. And over the course of the past 30 years that I've been doing this, I've been working one-on-one with those high-income individuals, the high-income business owners, the high-income W-2 professionals, the high-income real estate investors. I've been working one-on-one with them in order to really help them do the exact same thing that I've been doing, right? So in the game of business and finance, I'm both a player and a coach, right? So that's why I'm here. I'm here to help you elevate financial literacy. Now, here's the harsh truth. The harsh truth. As a high-income W-2 professional, you are paying taxes pretty much on every dollar you earn, right? Like, you know that to be true. You get almost no real deductions, and you can't time or shift your income, right? So you're sitting here in this frustration ecosystem because you're constantly exposed to the erosion of taxes. You're overpaying consistently. And that's the problem, right? That's the problem as a high income W-2 earner that you have to contend with, right? That taxpayer ecosystem that you live within is one that is truly harsh, right? So what I want to get into today is talking about the landscape that you're dealing with, right? So giving it some context, you as a high income W-2 professional are the backbone of the tax system, right? Lucky you, you're the backbone. Why? Because W-2 earners making more than $250,000 a year are the most aggressively taxed here in America, right? They're the most aggressively taxed. You don't get to write off the aspects of your life that business owners get to do, right? You don't get to potentially have vacations that are essentially, at least in some way, paid for in part by the IRS, right? You don't get to deal with your commuting life, right? Your driving of a vehicle in such a way that could potentially be tax advantaged to you. You don't get to have aspects of your home that your business potentially could be paying for and getting tax deductions in order to do, right? You don't get those benefits that business owners do. You are stuck in this quagmire, it's an interesting word, right? Quagmire of just tax erosion, right? It's the dollars are coming in and they're going out faster than you can actually start to touch them, right? You see, you pay taxes before you even get to see the money, right? You know that, right? Like you get your pay stub and you're looking and you're like, what, that dreaded F word, what the FICA? Like who's FICA and why does he take so much money, so much of my money, right? Right? That's the reality of a W-2 life, right? Whereas owners, right? So we have the doers in society, the workers in society, and then we have the owners in society. Owners, well, they still get exposed to taxation. Don't let anybody tell you differently. They do, right? But they get to pay after they see their money, right? That's the interesting game that exists within the tax code. You see, the IRS loves you. And the government actually depends on you. Government depends on you. Now, you may have heard that only business owners, like let me make sure I'm highlighting that, because that's critically important. You may have heard that only business owners get to leverage tax strategies to reduce their income. Let me know in the chat. Have you heard that? Like only business owners get the benefits? The tax code is 70,000 pages long when you add together the code itself, the IRS regulations on top of the code, different notices that they put out to the tax-paying public, right? When you put it all together, it's like 70,000+ pages long. And the vast majority of it is written towards the benefit of business owners, right? To owners in general, owners of society. And while you may have heard this to be true, the reality is that W-2 professionals, you're not going to rely on luck in this game. You're going to start to rely on the law, right? Because in reality, you don't need to be a full-fledged business owner in order to reduce your taxes. But you need structure. You need structure. You see, when you think about the tax code, I want you to understand something. This is a writer downer, guys. The tax code is a recipe book, right? It's a recipe book. It's an incentive system. It's looking at trying to understand how to do things and incent you to do things. And the government gives you 3 incentives, right? They give you tax deductions, they give you tax credits, and they give you exclusions. The most beautiful word in the tax code, right? Exclusions are like a cloak of invisibility around your money. The IRS doesn't even see it, right? I love that. But the reality is, as a recipe book, just like with any recipe, like if you wanted to bake a cake, right? You need more than just the ingredients, like the flour and the eggs and the cacao, right? You need more than that, and the sugar. You actually need infrastructure. You need the pots, the pans, the spatulas, right? You need all that stuff, right? Because that infrastructure makes it possible to put the ingredients together. So that's why structure is critically important. And in our ecosystem, when I sit down and I mentor these high-income individuals, the business owners and the W-2 professionals and the real estate investors, a lot of the first few weeks, if not couple of months of interaction together, it's all focused on structure. Like, how do we structure their entirety of their life the right way so that they can start to leverage the strategies that are available to them, right? And that's the key point. So I want you to understand, if you're going to write anything down of today's presentation, like the critical point to really hit home on is that structure is what makes everything possible when it comes to tax reduction. Structure makes it possible for you to keep more of every single dollar you make, right? So if you're going to do anything, hear what I'm saying, that structure is critically important. Structure is critically important. Now, the reality is, as a W-2 professional, there are a few different things that you can be doing to reduce your tax burden with no business required. Like, so let's assume that you're not going to engage in any type of business activity whatsoever. You're just going to continue to be a W-2 employee, a professional who's earning a lot of money from an employer, and now you want to figure out how to reduce your tax burden. Well, there are a few key things that you can do. And the first thing that you can do is you can go ahead and maximize tax advantaged retirement buckets. Tax advantaged retirement buckets. Now, oftentimes you hear about this in the context of a traditional retirement vehicle. Now, I'm going to share my bias with you so that you understand these things from my perspective. I am not typically a big fan of traditional retirement vehicles. And the reason for that is because that is a deferral strategy, a tax deferral strategy. And personally, I believe we are at historically low income tax rates, right? Again, I think the tax rates are still stupid, but historically speaking, they're at the lowest rates that they've been in a very, very long time. And the reason for that is if you look at the entirety of the tax code, the history of the code since it's been in force, about 76% of the history of the tax code, the tax rates have actually been higher than where they are today, right? And if you have a belief in a lot of the things that are coming down the road with regard to the realities of life and how the government operates and the cost of government operations, at some point in time, I have a strong belief that tax rates will have to go up. There's not going to be an option, right? They're going to have to raise tax rates. So if you're engaged in a tax deferral strategy, you are hoping that in the future, tax rates will be lower when you start to pull money out of those traditional retirement vehicles, because when you pull those dollars out, they will be taxed at that time. You get a tax deduction for the money going in, and when the money comes out in the future, you get income taxed. So if tax rates are higher at that point, or your lifestyle in general, and you have other things that are generating income, and therefore your overall income has gone up in the future, well, then you get exposed to more taxation. So the deferral strategy in my book is not necessarily the best approach as an all-in strategy. Doesn't mean it can't be a component of what you do, but if you're going to go really all in on that, I personally don't think that that's the best approach, right? The best approach. That's why I do like Roth alternatives, right? Roth alternatives. A Roth is, again, a retirement vehicle, but instead of getting a tax deduction when the dollars go in, the account will gain deferral during the money staying in the account, meaning there's no taxation while it grows. And when you ultimately take that money out in the future during your retirement years, there's no income tax, right? So the Roth approach, I believe to be better. Now, when you're looking at maximizing your tax advantage retirement buckets, I'd encourage you to think strategically about tax advantage in such a way that it's not necessarily about what you get benefit today. It's the net benefit over your lifetime. And that's why Roth in my book wins out every day, right? Because you create a bucket of money that will escape taxation forever, right? Now, inevitably, when I start talking about Roth in the comments or in the live streams, individuals will tend to say, well, Edward, what, like the government will just change the rules. And yeah, they could. They absolutely could, right? I'm not naive. The government changes the law all the time. But what I do know to be pretty darn accurate is that when they change the rules around tax-related matters, when people have made a decision that is pretty much a locked-in decision, meaning you're doing something that's undoable, right? The IRS tends to grandfather in that thing. So as an example, if you put money into a Roth vehicle today and you didn't get any taxation and it's growing tax deferred, I believe in some way if they were going to change the law around Roth, in some way you'd be grandfathered for the decision you made because at the time you made it, you were relying upon the conditions of the Roth, right? I believe that to be true. And historically speaking, when tax codes and rules have changed in the past, in similar contexts, that is what the government tends to do. So I do not believe it is a high risk event for many to dive into the Roth under the assumption that something could change in the tax law down the road, right? I just don't believe that's a high risk event. However, the benefits, if I'm right, are significant, right? Because now you have tax-free money forever. Now, what does this look like to maximize your tax advantage retirement buckets? Well, first, you look at your existing employer and whether or not they have a plan that you can participate in. And if they have a match, you definitely contribute at least up to the match. Now, in a retirement plan, a 401k plan specifically, there's an annual limit that you're allowed to contribute. The total amount. And in 2025, the total amount that is allowed to go into a 401k plan is $70,000 if you're under the age of 50. There's like a catch-up contribution that you could put in once you get over age 50, but the maximum amount that can go in is $70,000. Now, as an employee, you're allowed a maximum amount of tax deferred contributions, meaning the contribution that you put in as an employee, there's a maximum amount you as the employee are allowed to put in and get a tax deduction for doing so. And in 2025, as the employee, the maximum you could put in if you're under the age of 50 is $23,500. And you may be saying, Edward, you just said 70,000. Well, that's true. Because the employer is allowed to match as well. They're allowed to contribute. And the combined amount that you as an employee and your employer can put in, the maximum amount is $70,000. Now, as a tax deferred contribution, the maximum you can put in is $23,500, right? Now, that doesn't have to be what you do. You don't have to do a tax deferred contribution. You don't have to take that deduction on the way in. You can opt to contribute to a Roth component so long as your employer offers that as an option within your 401k plan. So these are the types of things you want to do. You want to have a conversation with your employer, your HR department, and say, hey, listen, give me a little bit more explanation as how my 401k works. Like, what am I allowed to do? Am I allowed to make after-tax contributions? Am I allowed to contribute into a Roth vehicle within my 401k plan? Am I permitted to go through this process of contributing in such a way that maybe I contribute an after-tax amount and then I can do an in-service distribution? That's another concept, an in-service distribution. A lot of 401k plans permit this, meaning you're allowed to make a contribution while you're still employed. You can roll out your 401k plan to a self-directed vehicle, right? And a personal IRA as an example, or a Roth IRA if we're talking about after-tax contributions, right? An in-service distribution is when you're still employed by your employer. Does the 401k plan permit you to take that money out of the 401k plan and roll it into a self-directed retirement vehicle, like a traditional IRA or a Roth IRA? Like, these are the questions you want to have with your HR department. That's what it comes down to, this concept of a backdoor Roth IRA strategy. You see, as a 401k plan participant, a lot of high-income W-2 professionals have been told by their accountant that they can't contribute in a Roth IRA, right? Because you're participating in a 401k plan, your income is too high, you can't contribute into a Roth IRA. Well, that's also not true. That's not true. You can indeed contribute to a Roth IRA. And the way you do that is through what's called a backdoor Roth strategy. This is when you contribute an after-tax contribution into a traditional IRA, right? So a non-deductible contribution into a traditional IRA. And then immediately the next day, you convert that into a Roth. You see, there are income limits for a contribution into a Roth directly, but there are no income limits for converting traditional IRAs, right? None. No income limit at all. So you could just make an after-tax, meaning a non-deductible contribution into your traditional IRA, and immediately convert it the next day. right? So that entire amount, that contribution can immediately be in a Roth IRA. This is how you start to maximize your ability to create these buckets of tax-advantaged dollars. Tax-advantaged dollars, right? So again, what we're talking about here is figuring out how you, as a W-2 professional, high-income W-2 professional, can start to win at this wealth game. And tax reduction, whether it's in present day or over your lifetime, tax reduction is a significant ingredient in the creation of generational wealth. Now, I recognize this is not stuff that you've been taught in school, right? Like financial literacy is just not there. Like, well, don't take my word for it. I'm curious what you guys think. Let me know in the chat. Let me know in the chat if you learned financial literacy in school. Yes or no? Yes or no? Let me know. Did you learn financial literacy in school? I definitely didn't. Let me know. Let me know. Let me know in chat. Let's interact. Let's have some fun together. It's a beautiful day. I'm here in South Florida. Hell no. Man, I'm right there with you. Of course not. AJ, of course not. No financial literacy in school. Andres, I agree. Irene, no. Right? See, this is what gets me so frustrated. There are rules to the game that you're intentionally not taught. That's a problem, right? That's why so many struggle. The reality is that wealth, money, it's infinitely abundant. It's infinitely abundant because all dollars follow value creation. And you can go out into the world and create more value, which means you can get dollars. But they don't teach you how to do that. And they definitely don't teach you how to hold on to them, right? And that's why I spend so much of my time doing this, because again, I hate the government. I want you to succeed. See, if I could teach you to be an amazing steward of wealth, that means the government gets less. They lose, I win, I'm happy, right? So that's why I do what I do, right? So let's really dig in, because this concept, maximizing your tax advantage retirement bucket, is beneficial, but it's just one aspect of what you could do as a high income W-2 professional. Now I notice here, like this right here, the 66 is wrong, right? That was last year. It's 70,000. 70,000 is the maximum contribution. I mentioned that while we were talking, but I want to point out inaccuracies and typos in my own stuff, right? I'm not perfect, guys. Not perfect. I'm a human being just like you guys. Well, hopefully everyone here is human. Government, get out. If you're watching this, IRS, leave the chat. They always spy on me. They always spy on me. Okay. Option number two, or strategy number two, as a high-income W-2 professional that you can employ, potentially, is health-based tax shelters. Now, some of you, again, not all of you, you have to talk with your HR department, you have to talk with your employer, right? But some of you may be able to take advantage of health-based tax shelters. Specifically, the one that I love the most is something called an HSA, a health savings account. This is pretty much the only account that exists that is triple tax advantaged. Triple tax advantage. I had someone, I did a post just recently, this week actually, over the course of the last couple of days on Instagram and TikTok, where I did a reaction video that dealt with this concept of HSA. And someone commented, isn't a Roth IRA a better vehicle? And my reply, when I dove into the comments, my reply in the comments was no. The HSA is actually the only account that's triple tax advantage because you get a tax deduction for putting money in. While it's in there, it grows tax deferred. And when you take it out for qualified medical expenses in the future, it's tax free. Triple tax advantage. It's the only one that exists. Now, don't get me wrong, smart wealth creators use both. They use the Roth IRA and they use the HSA. Again, where available. Not your employer may not have that as an option. What I mean from an employer is it's not the employer that's creating the account, but it's required to have something called a high deductible health insurance plan in order to have an HSA. Right? You have to have a health insurance plan that has a high deductible as its component. And your employer typically is the one who's providing the vast majority of high-income W-2 professionals with their health insurance plan. So if your health insurance plan does not have a high deductible, given the guidelines that the IRS has for those types of plans, then you can't have an HSA, right? An HSA doesn't require your employer to have the account, right? The HSA account. You get to establish that on your own if you wanted to. Now, some employers do provide the mechanism for you to actually automatically have an account set up if, again, all of the right parameters are in place. But these are the types of conversations you want to have with your HR department and your employer if they don't have a full-fledged HR department, right? But this concept gives you the ability to have an account that allows you as an individual, like if it was just you, right? You could contribute up to, I believe actually these numbers may be off too, but I believe it's in that low four range, right? 4,000 at least. 4,300 maybe, but either way, 4,000 and change as an individual, 8,000 and change as a family, right? 8,000 and change as a family. Now, the dollars that go in, again, you get a tax deduction for the contribution, right? So it is an upfront tax savings option. While those dollars are inside of the HSA, you can invest them. Right. Typically, most HSA plans have like mutual fund alternatives that you can put those dollars in. Some HSAs provide access to things like ETFs. Right. It depends on the plan itself, but you're investing those dollars, and potentially those dollars are then growing inside of the plan, and that growth is tax deferred, meaning you don't get income tax while those dollars are in there. And by the time you take those dollars out for qualified medical expenses in the future, those dollars coming out are tax-free. Tax-free. Significant benefit, guys. Significant. Now, here's the real secret sauce. And again, I mentioned this in the reaction video I did this week. The secret sauce is that so long as a medical expense is incurred after the plan is established, right? So let's say in 2025, you create your HSA account, right? You open it up. So long as a qualified medical expense is incurred after the plan is set up, but you choose to pay it out of pocket, meaning you don't tap into the plan to pay for that medical expense. You pay with your cash flow, right? And you keep the receipt. At any point in the future, next year, 10 years from now, 25 years from now, you can reimburse yourself in that future date, as long as you have the receipt, for that previous medical expense. And then you could use those dollars in the future for anything you want, right? Because you're reimbursing yourself for an expense that was already incurred. I have a client who did this, and she essentially stockpiled for about 10 years all of her receipts for all of her out-of-pocket medical expenses. During that entire time she was contributing into the HSA, the money was growing inside of the HSA. She had done really well with her investment options and selections there. And she used the money that she reimbursed herself to buy a cruise, a significant cruise. It was one of those multi-country cruises. It was, I think it was like 30 weeks. It was like a very long cruise ecosystem. But she paid for it entirely out of her HSA, tax-free. Because she was just reimbursing herself for the previous incurred medical expenses and allowing her money to compound tax-free over a decade. This is a powerful strategy, guys, powerful. See, when you learn the rules of the game, you can start playing to win. Now, an FSA is similar type of situation, right? But under the new One Big Beautiful Bill, we understand that dependent care limits have increased to $7,500 up from $5,000, right? And you can use it for child care, elder care, qualifying dependent expenses, right? These types of savings accounts are health-based in nature, and they give us a tax shelter for the contributions that are going in, right? This is why this is powerful. And if you don't know about these things, you should be reaching out to those people that you trust, the financial professionals that are in the know, that are in your life, and start asking these questions. Say, hey, listen, I was watching this crazy guy on YouTube or on Facebook Live, because I think my team is also trying to stream this to Facebook Live, right? And if Facebook is here, say hi. Say hi. Oh, we got some people saying hi. Awesome. See, the reality is we're not taught this stuff, right? So you don't learn the rules of the game. And if you don't go out and start asking these questions, so again, I saw this crazy guy on social media talking about these things that I could be doing as a high income W-2 professional. Why am I not doing them? Right? Why? Because that's the reality. I come into situations where people are like, why didn't anyone tell me this? Why didn't anyone tell me this? Right? And the reality is, it's because most people are not focused on your well-being. They're just not. They're focused on their own. You see, there are a variety of strategies that you can leverage. And the next one that I want to talk about is one that actually goes out and benefits beyond you, right? It's this concept of charitable planning optimization with donor-advised funds. Charitable planning optimization. I have a large number of clients who have felt personally that they've done so well that they want to try to give back, right? But here's the reality. When it comes to your personal tax return, you have two options when it comes to how you get deductions on your personal tax return. You can either itemize your deductions, which means you go into a separate schedule and you simply list out all of the things that you spend money on, and you have to deal with all the consequences of what certain thresholds are and certain allowances are. And then you total all those things together, and then potentially, depending on the dollar amount there, you would use that dollar amount, those itemized deductions, to reduce your taxable income, thereby making a lower amount that actually gets hit with taxes. Or, since TICJA, the Tax Cuts and Jobs Act that was passed or brought into the spectrum late 2017 into 2018, you have a standard deduction that you could take, right? Which is just a flat amount, right? $15,000 as an individual this year, or $30,000 as a married couple filing jointly, right? But here's the interesting thing. I have a number of clients who want to give to charity, but they don't necessarily get to those levels where the dollar amounts, when you add them all together in any given year, exceed the standard deduction as a married couple, like that $30,000+ per year of standard deduction. So the pro tip here is that you can actually use something called a donor advised fund. Whereas you make a contribution, let's say you had, again, I'm using fictitious numbers here just to give you an illustration. Let's say you had $100,000 that was sitting on the sidelines, right? Sitting on the sidelines. And let's say you earn $500,000 a year in taxable income. And let's say on average, you're giving $20,000 away a year. Again, you're not exceeding that $30,000 standard deduction. Well, you could take that $100,000, contribute it into a donor advised fund, and get a tax deduction for the entire $100,000 this year, but you get to direct how and when that $100,000 is ultimately distributed to those causes that you care about. Right? You could spread that out over the course of the next 5 years if you wanted to, $20,000 a year, but you get the full deduction this year. Right? This is about strategy, right? You get the deduction when you make the contribution into the donor advised fund, and you get to actually distribute that. You get to direct the distribution of those dollars how you see fit and when you see fit. Right? This is about strategy. This is why I love this stuff. Like, have you ever heard of this? Have you ever heard of this? Like, this is powerful. Let's do this, right? Let's do this. Let's say, again, you have, let's do it this way. Here we go. You have $500,000 of taxable income, right? Taxable income. You have $100,000 sitting on the sidelines. Like it's sitting in your non-qualified investment account. And you know that of that $100,000, you're going to give $20,000 away this year because that's what you normally do, right? Well, instead of doing that, you just take the entire $100,000. Now your taxable income is only $400,000, guys. Huge tax deduction. And for many in the tax bracket, that's going to save you a significant amount of money, right? $100,000+ of tax savings, right? Well, tax deduction, $100,000 of tax deduction, right? Which would potentially be like $30,000 potentially in your pocket. Again, it depends on what your effective income tax bracket is, right? What your effective income tax rate is, right? That's what a donor advised fund contribution can do for you. And then you just say of that $100,000 that goes into the donor advised fund, year one, 20,000 goes to charity. Year two, maybe you want 30,000 to go to charity. Year three, right? Year three, maybe you want 5,000 to go to charity, right? You get to, and while it's in the fund, it grows tax free, right? Because it's in a charitable oriented fund. You get significant benefits by locking it up in this way, right? Because you get the tax deduction in year one when you make the contribution. And then next year, let's say you want to make another contribution into the donor advised fund. You get another deduction, right? This is why it matters for you to sit down with someone who actually knows the rules of the game and is more than just one-dimensional professional, right? Because that's the other problem that you have to deal with. The vast majority of helpers that you may have access to are unidisciplinary, right? Meaning they only know their own discipline. They are either, let's say, an accountant, right? The vast majority of accountants are compliance experts, not tax strategists, compliance experts. They know what number goes into what box on what form so the IRS doesn't get mad, right? That's compliance. Necessary, but not the same as tax savings, right? Most accountants aren't there to save you money on taxes. They're there to file your returns for you, right? So that the IRS doesn't get mad, right? They're a glorified historian. They're spending all of their time, their effort, and their energy just trying to figure out how to best tell the IRS what already happened. That's a yesterday job. A tax strategist can give you some great strategy, right? But again, that's still a unidisciplinary, because tax strategy is just one aspect of the game. Because without, remember the key thing I told you to write down at the very beginning of this session, structure is what matters. Because you can have the best strategy, but if you don't have the structure to employ it, it doesn't do you any good. It doesn't do you any good. So structure is critical. So you need an asset protection attorney. You need a business strategist, right? Those two professions are also still unidisciplinary. You want to figure out legacy. You're going to need an estate attorney, right? You're going to want to understand, well, how do I invest that donor advised fund? You're going to need a financial advisor. The problem is most of those professionals that you go out and find piecemeal, they never communicate with one another. So it leaves it to you to try to help keep them all on the same page. And guys, you know the truth. You're not going to do that. You're not going to be able to because you don't speak their language, right? That's just the problem that you have to deal with, right? It may not be your fault, but it is your problem, right? You got to deal with it, right? And there's a variety of different options for you to go out and deal with it. Like our ecosystem, our goal, we have multiple disciplines. Like I'm a lawyer specializing in tax, estate, and business law, but I'm also a serial entrepreneur. I own a private wealth management firm. I own a tax firm, right? So I have multiple disciplines of knowledge and experience, plus I have other professionals on the team that add value, right? Now, again, the concept is figuring out how you can take strategy and reduce your tax burden while also starting to play the wealth game, right? Tax reduction is ingredient number one. Like if you look at the creation of generational wealth, the very first step is to keep more of every dollar you're making, right? But we also want to protect those dollars from all the enemies at the gate, the creditors, the litigants, the opportunists who want a piece of your pie. We then want to put those dollars to work. Go out in the world and find friends. Right? If you don't give your dollars a job, they become the employee of someone else. So give them the right job. Track their progress. Evaluate whether or not they're doing good work, and if they're not, adjust. Right? Capital allocation and investment decisions need to be ongoing. It's not a set it and forget it thing. Not if you want generational wealth creation. Like if you just want to be okay, which some of you may, that may be your goal and objective. And if that is the case, kudos to you. Like I'm happy for you. But if your goal is generational wealth creation, a set it and forget it strategy doesn't really get you there. It doesn't. Again, I've been doing this for nearly 30 years, guys. I know what works and what doesn't. Set it and forget it doesn't work for generational wealth creation. It's a component that can give you some security, right? Can help you have a decent life. Still amazing. The vast majority of people in the United States are not high income. Right? The average income right now in the U.S. is somewhere around $74,000, depending on who you ask and who you get that data from. About $74,000 for a family of four. Average, right? Whereas the average cost of living in the United States is about $60,000 for a family of four. Average. And you guys know if your income is $74,000, you're not netting $60,000, right? Because you have taxes. Right? So the average person is financially bankrupt. So if you're on here and you're a high income professional, W-2 professional, you are amongst the individuals who are winning in life, right? You've won the lottery. Now, granted, you did work for it likely, right? Because it's unlikely that you just fell in luckily into a position of financial wherewithal, right? You've worked hard to develop skill sets, et cetera, to make it so that someone says, hey, listen, this person adds enough value that I'm willing to pay them sizable sums, right? So you've won the lottery, but you've earned that lottery winnings at the same time. Now what I'm trying to do is help you do even better. I do even better by understanding the strategies that can result in you keeping more of the dollars you're working hard to create now. Now, again, we're talking about things that you can do without jumping into the business ecosystem, without leveraging the ownership benefits that are built within the tax code. We're talking about the producer benefits right now, the individual doers, the W-2 participants, if you will, the employee component. There are also some new W-2 specific deductions that are available for non-business owners, right? W-2 specific deductions that are part of the One Big Beautiful Bill. And you probably heard a lot about this because they were part of campaign promises and they got a lot of traction on traditional media. And the first is that overtime deduction. Now, the reason why it's a deduction this year is because, quite frankly, there's no time to change all of the payroll processing systems that are out there. And it is likely that in 2026, this will become a component of just payroll as a whole. Like you wouldn't necessarily have to worry about it being a deduction in future years. That's still something that's being worked out, right? The implementation of the One Big Beautiful Bill is something that is still being designed, right? Because even though the bill has been signed into law, those that govern the actual apparatus that is our tax ecosystem have to actually put it into practice, right? They have to go through the process of modifying tax forms and modifying elections like W-4s, et cetera, right? They have to go through that process, and that's going to take time, right? But for now, what we know to be the likely outcome is that in 2025, if you're participating in an overtime type of ecosystem, you're going to have up to $12,500 as an individual, or up to $25,000 if you're married filing jointly, that you'll get to essentially deduct from that overtime income that you generate, right? But it is being phased out. So if you are truly high income, like again in that 250 range, unfortunately, you're probably not going to benefit from this particular deduction, right? Because that's really going to be phased out starting at about $150,000 of adjusted gross income. Now, the tip income deduction, same scenario. It's in the future, this might likely be something that literally gets excluded from taxation while you're earning the tips. But for now, since payroll systems and processes have not yet been updated based on the July 4th, 2025 signing of the One Big Beautiful Bill, the tip income ecosystem, the benefit that was part of that bill, is going to likely be a deduction that we'll see on the 2025 tax return that gets filed in 2026, right? Now, again, it's up to $25,000 against your tip income. but it's only for those workers that are in qualified industries. So industries that traditionally have tip income, like think hospitality as the example. And it's only if that employee was employed before December 31st, 2024. But again, it's being phased out. Once you hit $150,000 as an individual filer or $300,000 as a married couple filing jointly, this particular deduction goes away. Right, so it's not the thing that's going to win for most of you who are watching this, I'm sure, right? Because if you're in our ecosystem, you are likely a high-income individual, right? Whether, again, a lot of people who watch our content, whether it's on Instagram or TikTok or Facebook or YouTube, right? Most of our content resonates with those who are actually making money, right? Because they are hit with that gut punch of the tax bill every year. And they want to figure out how to solve that. And that's what I specialize in doing. I specialize in helping those individuals work toward the creation of generational wealth. So again, this particular benefit under the One Big Beautiful Bill is likely not going to be a benefit that many of my constituents are going to leverage. But maybe your employees will, if you're a business owner. Maybe your children, if you are a high-income W-2, maybe your kids are getting started in life and you can direct them, because it's not just about you, right? When I talk about generational wealth, I'm talking about the family, right? So you should share the knowledge, right? Make sure that those that you love are in the know with what is possible now based on strategy, We also have this interesting thing, the student loan repayment tax exclusion. It's been made permanent now. It was set to expire. Your employer can basically pay down student loan debt to the tune of $5,250 per year, and the employer gets a tax deduction, and you as the employee get to receive that benefit as an exclusion, right? The most beautiful word in the tax code. You don't have to report that. It doesn't fall into the income tax return, right? You got the benefit because the employer paid that debt for you. They got a deduction for doing it, and you did not get hit with an income tax for that happening. So here's the pro tip. Talk to your employer. Say, hey, listen, did you know that there's this benefit where you can pay my debt, and I don't have to pay any income tax on that? So instead of, and here's the thing, a lot of people think that has to be, an additional benefit. No, you could just renegotiate your existing one. Like if you're already paying $5,200 a year towards your loan repayment, instead of doing that, just tell your employer, reduce my compensation by $5,250 and just pay my debt instead, right? They're no worse off. They're paying the same amount. They're getting the same amount of deduction. You are getting less taxable income. And you would have had to pay that $5,200 with after-tax dollars. Why do that? You can get to pay it with pre-tax dollars and get the benefit. This is strategy, guys. Are you picking up what I'm putting down? Is this resonating with you? Let me know in the chat. Let me know. And again, if you're watching this on replay, let me know in the comments, right? It is a beautiful day here in South Florida. And if you are not like shouting from the top of your lungs that I'm ready to save taxes, I don't know what you're doing, right? Like this gets me excited. Hopefully it gets you excited too. Okay, so here's the reality. Again, we've been talking about what you can do as a W-2 professional to reduce your tax burden without going through the process of becoming a business owner or engaging in a side hustle or going through and investing in real estate, without jumping into this ecosystem that is ownership. But here's the reality. Owners and investors are the ones who actually benefit from the tax code. You may not want to hear that, but no matter how much you wish it weren't true, it is. Right? The tax code, more than 70,000 pages when you add up the legislation itself, all of the notices and the resources and the materials, the supporting documentation that the IRS and Treasury issue, right? Like when you add all that, plus the court cases, right? When you add it all together, it's more than 70,000 pages, and the vast majority of those written words are aimed towards ownership. Right, aimed towards ownership. And because it is an incentive ecosystem, it's designed to get you to do certain things, the government is really motivating those to get those who are capable to get into the ecosystem that is ownership. Ownership. Because owners and investors, let's look at this. Owners and investors get to control, maybe, let's see. I don't know. Oh, there we go. Owners and investors get to control. Actually, I don't get to control anything because I'm only in viewing mode. I'm going to go into editing mode. They get to control. See, I can figure it out. I know technology. Gotta love it. Gotta love it. Owners and investors get to control their income flow. They get to control it. They get to leverage. They get to leverage legal entities. They get to leverage them. They get to shift their income to tax-friendly structures. Tax-friendly structures. They get to reduce liability. Right? So when you look at your overall life, there are two different types of liability that exist: inside-out liability and outside-in liability. But as a W-2 individual, you're really subjected to outside-in liability. Like you're driving down the street. I call it the Bentley effect. Like you're driving down the street in a Bentley and you crash into a Toyota Corolla. They saw that you're driving a Bentley. Like if you're a high-income professional, right, it is likely that you would be a target in a litigation event if you cause someone harm out in the real world. Right? They'd come after you. They try to take your stuff, right? And then without the right structures in place, they may win. They may succeed at that. Right, but the owners and investors get to really structure things in their life in just the right way to prevent that, to reduce, to mitigate that type of risk. They get to create tax-free wealth because they get to really maximize all of the tax strategies. See, the reality of the world is that the vast majority of people out there are playing Twister while the wealthy are playing chess. And no matter how hard you try, if you are playing the wrong game, you will always lose. And even if you're playing the right game, but with the wrong set of rules, how can you ever hope to win? Right? And that's why learning the rules of the game is so critically important. But they don't teach you this stuff in school. Hopefully you're getting value by watching this, right? Because I'm trying to elevate your financial literacy. I want you to win. I genuinely want you to succeed, because when you become an amazing steward of wealth, that means less dollars go to all of the ridiculousness in Washington, D.C. I hate those guys. I think that's all corruption. So they lose. Society wins. Right? That's a good thing. That's a good thing. Here's the game plan. There is an opportunity to get tax reduction and wealth strategies to be unlocked if you are willing to engage in side hustles, real estate, or even full-fledged business ownership. And let's talk about a little bit of this. You see, if you're willing to start a side hustle, again, I'm not saying exit your W-2 ecosystem, but if you're willing to engage in a side hustle, even if that side hustle is light consulting or advisory work, it could be a side hustle like buying a couple of vehicles and listing them on Turo, right? You can have someone else manage it, like run the day-to-day operations, but you own that business. I have a client, this is now a couple years ago, 2023, who went out and bought 43 Airstreams, like the big RVs, like the $100,000 plus RVs, got millions of dollars of tax deductions, right? Because we were able to leverage a specific aspect of the code to get major benefits, right? So even if you're willing to engage in a side hustle, because that was a side hustle, right? A very, very big side hustle, but it was still a side hustle, right? But even if the side hustle is light, like light consulting, a light advisory work, you see, business does not require a full-time startup, right? You just need some income generating activity that you are in control of, right? And then we get to unlock some major tax benefits but when that happens, right? The first is something called the QBI deduction. This is 199A of the Internal Revenue Code, section 199A. This gives us the ability right off the top for qualified types of income, right off the top to take a 20% deduction right off the top before taxes are even considered, before like anything else, right off the top, $20,000 comes right off. Huge benefit, simply because that income is organized in such a way as it's now ownership oriented income. It's not you as a W-2 participant, right? So that's why the side hustle is critically important. You also get to benefit from the home office deduction, where we can take a percentage of all of the costs that are associated with your home, whether you own the home or rent the home, right? It doesn't mean you have to own the home that you're living within, but we get to take some side benefits because we have a side hustle, right? Business use of your vehicle, right? We get to categorize some of that vehicle utilization as business use and thereby potentially getting some significant tax savings all along the way. So again, you heard me talk at the beginning where this concept of an owner gets to sort of like deduct aspects of their life. Well, this is how, right? You use the right strategies. Your travel and maybe some of your business meals. You get a deduction for doing that. Again, you get to benefit in, again, I'm not saying do stupid things. I'm not saying do some of the stuff you hear on TikTok or on Instagram, these sound bites from these supposed financial gurus, right? I'm talking about black and white, legitimate strategies. You have to just know how to do it the right way. How many people in the chat have kids age 17 years or younger? Kids age 7, let me know in the chat. Say me. Say me in the chat. If you have children age 17 years or younger, let me know. Let me know in the chat. I'm curious. Children 17 years or younger in the chat. Say me in the chat. Say me. Awesome. Andres has minor children. Here's the benefit. When you have a side hustle, you can hire your kids in that side hustle. Pay them for legitimate work that they're doing. Pay them the amount you would have normally spent on them anyway, right? Normally spent on them anyway. You shift that income now from your tax bracket to their tax bracket, and the first $15,000 that they earn is zero income tax. You're that right, zero federal income tax. Now, it has to be for legitimate services, right? There's no exposure to self-employment tax for them. There's no exposure to income tax for them. There's no exposure to unemployment tax or family medical leave, like all of the payroll taxes that are on your pay stubs, guys. Like they get none of that for the first $15,000 federally, right? This is huge, guys. Do you see like the dollar signs start to add up? When you start to do all this stuff, you get to set up a solo 401k. You start this side hustle, you get to set up a solo 401k, your own, that you control, that you can leverage fully. And if you make it a Roth 401k, you can knock this thing out of the park. Again, these are the strategies that the wealthy are using. And if you're not doing it, it's probably because you just didn't know. Or worse, you asked the supposed professionals in your life and they said, oh, you can't do that. Yeah, I mean, I've heard story after story. Oh, my accountant said I can't do that, or that doesn't work, or that's not a real thing. That accountant just doesn't know the truth. Everything I'm talking about is black and white, guys. This is not gray area stuff. I love being aggressive in the black and white. I do not touch a toe in the gray because there's a big difference between tax avoidance and tax evasion. And it's about 20 years in prison, right? So that's not what we're talking about here. We're talking about black and white tax reduction strategies. Tax reduction strategies, right? Another thing is if you're willing to get now involved in investment real estate, Well, real estate, when done correctly, is a business. Investing in real estate is a business when done correctly. And again, that puts you into the ownership ecosystem within the tax code, where there are significant benefits, because we could do something called a cost segregation study on real estate, which essentially takes a look at all the different components that exist within that property and divide those different components based on their respective useful life. Like all the stuff that has a 7-year useful life, all the stuff that has a 10-year useful life, like kitchen cabinets and flooring and fixtures and all those sorts of things. We group those all together, determine what the amount is, and we can potentially get a significant benefit because we could use something called bonus depreciation, because now the one big beautiful bill has reintroduced bonus depreciation at 100%. Right? So we get to bonus depreciate, meaning take a deduction in year 1 for the entire available bonus depreciation amount. Right? Those assets that are comprised. So let me put this into context, because I think it's important to understand understand aspects of the code. Well, I'll do that in a second. I'm waiting for Hector to get back into the background so I can show you what I'm talking about. So Hector's running. I just saw him run back towards the control room, so you'll be able to see what I'm drawing. Let's assume, because I want to share with you how this could potentially work. Let's assume, again, don't get scared by the numbers I'm sharing, right? You can add zeros to it. You can take zeros away from it. It's not magic. It's just math, right? Let's assume that we're talking about you going out into the world and acquiring a $1,200,000 property, right? So you want to buy an investment real estate asset, $1,200,000. Now, land is never depreciable. And the reason I'm talking about depreciation is because when you go out and buy a thing as a business owner, like let's say I buy a pen, the IRS says that this thing has a useful life of less than 1 year, so I get to take an expense of the entire purchase price in year 1, because it's not going to last that long, right? So I get to deduct this, I get to expense it in the year I purchased it. But there are certain things that are larger in dollar amounts that the IRS says, well, that doesn't really go down in value all at once. It goes down in value over its useful life. So you don't get to deduct it all at once. You get to deduct it over time. And that process is called depreciation. But land is never depreciable. So let's say in that $1.2 million, let's say $300,000 of that is land value. Land value. Whoop. Gotta add an A there, right? That would mean the improved value, the structure upon the land, is worth approximately $900,000, right? Structure value, right? Improved value, right? $900,000. What that structure is comprised of, all of its components, those separate components have different useful life. Like the roof has a useful life, the outer walls have a useful life, the floor has a useful life, the sidewalk has a useful life. That's an improvement upon the land. The driveway has a useful life. The landscaping has a useful life. All of those separate components have different useful lives. The IRS says under bonus depreciation rules that anything that has a useful life of less than 20 years, you can accelerate and take a deduction in year 1 for the entire amount. And on average, this is a rule of thumb. It's not an actual direct science. It's not a true formula. It's just a general like ballpark figure. About 1/3 of a residential property, about 1/3 of that improved value is comprised of assets that have a less than 20-year useful life. So in this context, about $300,000 is available for bonus depreciation. Meaning I potentially can deduct $300,000 in year 1. Now, there are other rules that we have to contend with. There are certain rules that you have to deal with regard to getting access to those, right? The real estate professional status, which is your ability to convert passive losses, meaning depreciation in real estate, because real estate by default is considered to be a passive activity. So if you engage in that real estate professional status and you do it the right way, we could take that $300,000 deduction and apply it against your W-2 income. So let's say your W-2 income, I don't know, say as a hypothetical, your W-2 income is $800,000, right? W-2. We take a $300,000 bonus depreciation. That means your taxable income is now $500,000. This is huge, guys. A $300,000 deduction could save you like $120,000 in taxes. And to buy a $1.2 million property, maybe you're coming out of pocket from your savings, from your investments. Maybe you're going to use $200,000 of that as a down payment. Again, you work with your lender to figure that out. So down payment, right? Down payment. Gotta love my chicken scratch, right? But your $200,000 down payment. But maybe for this, you got $120,000 tax savings. Tax savings. That's actual dollars in your pocket. So essentially, the IRS fronted $120,000 of the $200,000 you use. So you really only out of pocket $80,000. That's your investment to buy a $1.2 million property that is going to provide cash flow on a forward-going basis. This is wealth creation at its core. This is why this is so powerful, guys. This is so powerful. If you're not picking up what I'm putting down, man, go out and just have a good rest of your day. Because this is significant savings. Now, there's other options too, like short-term rental exception. This is when you go out and you buy a property and you're going to focus on it being like an Airbnb, right? And there are rules around that, which give you the same capability of pulling that bonus depreciation and offsetting your W-2 activity. There's something called a -4 election, which is when you're buying a commercial property and you're going to occupy it as the business, right? The business is going to take occupancy of that property, right? And then again, we get to do the same thing I just described, like taking that bonus depreciation and applying against your W-2 activity. There are something called opportunity zones, right? Which give you a capability of deferring and possibly even eliminating capital gains, right? Let's say you have a stock portfolio and your stock portfolio has $100,000 of capital gains in it. And if you go and sell it, you're going to get hit with $20,000 of tax. Well, if you invest in an opportunity zone with the proceeds of that sale, you get to defer that capital gains tax for up to 10 years. And if you stay in that opportunity zone investment for the entirety of the 10 years, that taxation goes away. You eliminate it entirely. You get to structure things in such the right way that you can actually pass on wealth to your kids and your grandkids without ever having that wealth exposed to taxation, right? When you structure your investing in real estate the right way and you're building a real estate portfolio the correct way, you should never be paying capital gains tax throughout the entirety of your life. And your kids should be able to inherit this when structured correctly in a way where they won't get hit with capital gains tax either. Right? There are so many ways that you can leverage the rules of the game to actually start playing to win. Playing to win. That's what this is all about. That's what this is all about. Now, here's really the crux of it. You can also consider transitioning to full business ownership. Right? When you're ready to say, hey, listen, I'm done being a W-2. Now, again, I'm not saying do that like rip the Band-Aid off approach, right? Maybe you start off with a side hustle. Maybe you start off getting involved in real estate investing. But over time, you may get to a point where, you know what, it makes more sense for you to now jump full time into your own thing. If that's the case. The core advantage here is you get to control the entirety of your income. You get to potentially put in play a multi-entity structure system, shift income to kids and to spouses and position that money through different structures in your ecosystem. You potentially could create your own captive insurance, where instead of paying third-party insurance providers, you get to get huge tax deductions while still controlling that money. You get to set up defined benefit plans. Whoop, I don't know how I did that. Let's undo that. There we go. Whoop, that didn't work. I don't know how that worked. I'm gonna have Hector deal with that. But either way, you get to set up defined benefit plans, right? You could potentially engage in qualified small business stock, right? You can go through the trust-based planning scenario, right? Trust-based planning scenario. All of these things are ways that you could potentially get involved in real estate and deal with it in such a way. Yeah, it doesn't let me undo that. Oh, here we go. There we go. I fixed it. See, I'm not that bad in technology, guys. Not that bad in technology. QSBS, qualified small business stock. This gives you the capability of going through the process of essentially being able to completely avoid capital gains tax if you sold your business in the future. Like you're building a business to exit, right? Again, it has to be set up the right way. You could engage in trust-based planning, right? Own businesses ultimately at the very top of your ownership ecosystem in trusts, so that you can actually start to leverage legacy as a component of everything you do, right? When you work the right way, you get the right outcomes. Right? Because the reality is, the real measure of success is this generational wealth creation. And a critical component for that is estate and legacy planning, right? Integrate it with the business activity you're engaging in. You can use things like intentionally defective grantor trusts in order to essentially allow for assets to be moved outside of your taxable estate for asset protection purposes as well, while still not really being negatively impacted from a taxation standpoint. Because a lot of asset protection trusts, when you leverage them the right way, there's an adverse tax consequence for that, right? So you can use an intentionally defective trust, grantor trust, in order to minimize the negative consequences from an income tax perspective when you leverage certain type of trust vehicles, right? Now, the reality is there are more than 77 different types of trust that exist out there. I did another YouTube session on the whole concept of trust. In fact, I talked about the 5 type of trusts that I personally use, that Edward Collins and his family leverage. Right? The 5 different types of trust. Now, if you have not seen that video, it's on my YouTube channel. So make sure that once this is done, once you've finished watching this, that you jump into that, right? Take advantage of it. Because I literally just gave you sauce, guys. I gave you sauce. You could set up spousal lifetime trusts. Again, I did the same thing. Gotta love this. But now I know exactly how to fix it, right? You get to leverage spousal lifetime trusts, right? So that you can carve out assets and make sure that your surviving spouse gets to benefit from those assets, right, while they're alive. You can have your life insurance owned by your trust so as to control the proceeds after you die, right? When you pass away, the death benefit, typically in most circumstances, individuals who have life insurance have named an individual beneficiary, so they personally receive that money without any challenge and without any fetters or controls. And I think the problem with that is when I sit down and I talk with people and I share with them, well, the reality is that means that money is now exposed to all of that person's creditors and litigants, including the potentiality of ex-spouses, right? No one wants to think about this, but if you have kids and grandkids, and I know some of you do because you mentioned that earlier, well, if that's the case, like when they get married, do you want what you've worked hard to create to necessarily be subjected potentially to marital settlement? God forbid something doesn't work out in the relationships your kids or your grandkids have, right? You could combine strategies that engage much more fully with this concept of charitable planning, like charitable remainder unit trusts and charitable lead annuity trusts, right? Like these concepts are strategies that you could potentially employ if you know the rules of the game. So my question for you is this, like if you look at this concept, like, because I teach this stuff to business owners, high income W-2 professionals, real estate investors, I teach something called the real wealth matrix, which essentially is the ideal hierarchy of ownership pretty much over everything in your life. And what you're seeing now, this is the blueprint. This is the blueprint. Remember how I kicked this all off telling you that structure is the most critical thing because it makes all of this possible? This is the structure that makes it possible. This is an intentionally designed infrastructure that leverages the framework called the real wealth matrix. And that essentially is founded on this concept of legacy, and it intentionally separates ownership from operations in life. Right? And I do that on purpose because of this concept of asset protection. This hierarchical approach to ownership is what gives us the ability to start taking advantage of real asset protection strategies, not the junk that you hear talked about on social media. Like, this is the stuff that actually works. And this is the stuff that not just works, but is manageable, right? It's manageable. You don't have to go through the process of trying to figure out, I don't know, which jurisdiction internationally you're going to try to hide your assets in by using an offshore trust, right? And then deal with all the consequences and costs associated with that. Now, don't get me wrong, those vehicles, those tools make sense for the right project. But the problem is, so many are just talking about these concepts in sound bites without helping you to understand how they relate to your actual circumstance. Hopefully you've gotten from me during this particular session an understanding that there are a lot of different things that need to be considered. There are a lot of different aspects of your life that are impacted by different decisions that you make. But if your goal is the creation of generational wealth, you need the right structure to make it all possible. And that's what this is. This is what we teach our ecosystem here at UpLevel. This is how we help our business owners from all across the country, 18 different industries, high-income W-2 professionals, real estate investors. This is the infrastructure because it's built on a framework, which means we get to modify and fine-tune this based on your own unique circumstance. So no one's real wealth matrix is going to look exactly like anyone else's because it has to be fine-tuned based on your actual circumstance. But it leverages trusts and holding companies and operating companies. It leverages family management companies and special purpose entities. It leverages beneficial operating companies. It leverages concepts and agreements like last wills and testaments, powers of attorney for financial matters, powers of attorney for healthcare matters, living wills, family foundations, irrevocable life insurance trusts, right? It leverages all of these different types of vehicles. And again, we incorporate things like the 5 different types of trusts that I use personally, land trusts and like springing trusts, like triggered trusts. Like all of those different types of trust vehicles. Again, there are 77 different trusts that exist in the United States. It's a lot to figure your way through, right? And when you hear sound bites on social media, there's no way that whoever's presenting that can give you the context that's necessary to figure out which one actually applies to your situation. That's why you want to make sure that you ultimately talk with someone who actually knows what they're talking about. Right? You have a conversation and you share with them more details about your circumstance so that they can fine-tune the right strategies for you so that you get the results based on your own personal objectives, your goals, your circumstances. Right? It is facts and circumstances dependent. That's why this is so critically important. Now, when we look at it, we spend a lot of time together, so we need to figure out which path are you going to choose. Right? We need to figure that out. Like, we have to understand, are you going to stay W-2 only, right? And if that's the case, not really a bad thing, right? Not a horrible circumstance, because you're here. If you're a high-income W-2 earner, you are likely in a scenario where you're doing rather well, right? You're doing rather well. But if that's the case, this is, again, a little bit too small. Here we go. That's the case, if you're doing rather well, we still need to figure out how to keep more of every dollar that's being made, right? So you still get some limited deductions. You still have to deal with the reality of being in that higher tax burden scenario. And you're restricted with regard to how your cash flow operates, right? Because you don't really have that control. But I shared with you some ways to reduce your tax burden, even if that's the case, if you're going to stay in that ecosystem. Again, it's not my right or role to tell you what you should do. What I can tell you is what is possible if you make certain choices. So the side hustle is a choice. It gives you more write-offs. It gives you a lower potential AGI so that you're exposed to less income taxation. It gives you the ability to start leveraging business expenses, potentially benefit your personal life in the making, right? When you do that, right? You start to figure out what things that are traditionally more personal in nature potentially could be oriented towards business, so that you get to have the business essentially help a bit, again, not directly, but a bit tangentially to lifestyle, right? Maybe you are interested staying W-2, but you're going to engage in real estate activity from a real estate investment standpoint. Well, then that opens up the door to depreciation and passive income and potentially asset appreciation. What I didn't talk about in the real estate mix is the reason I love it so much is it's because it's truly a wealth creation tool. Because even though I can't guarantee this, and again, nothing I'm saying here is a guarantee, right? Because I can't guarantee anything. What I can say is that traditionally speaking and historically speaking, over time, real estate tends to appreciate in value, right? So again, looking on the screen to you guys, it goes up, right, over time, right? But the reality is, as it's appreciating, you have a tenant in there that is paying down the debt at the same time. I refer to that debt pay down and real estate appreciation as the equity delta. The equity delta, right? That is wealth, because you could borrow from that equity tax-free, because borrowed dollars are not taxable to you. And you could use those borrowed dollars to go out and buy more real estate. I have a whole process with our mentees where I teach something called compound asset acquisition, which is this process of putting your dollars to work toward the creation of real wealth, right? Towards the creation of real wealth. Now, you may be sitting here and saying, well, Edward, I love everything. I love everything that you shared. But I want to go through this process of figuring out how to do it myself, right? How do I actually make this work for me? Well, there's a variety of things you could do. You could go out in the world and find an asset protection attorney, and you find an estate attorney, and you find a tax strategist, and you find a tax compliance professional, and you find a financial advisor, and then you find someone who can actually make sure all those people talk with one another and are on the same page and speak the same language and are aimed in the same direction toward your goals and objectives. Or you can try to find someone who can do all that for you. Now, I have no idea whether or not that person is me. What I do know, we could find out, right? You could fill out a quick questionnaire and see whether or not this is a fit. Like if so, I'd love to have an opportunity to help you make the steps in your own personal journey toward the creation of generational wealth. My team in the chat has put that link. Let's drop that chat link one more time so that it's fresh, right in everyone's easy clickable range, where they can just get in there and see whether or not we're a fit. It's a questionnaire. It's quick. It'll take you less than 5 minutes to fill it out. And if we are a fit, it'll give you an opportunity to consider booking a time to talk with someone on my team, to talk with one of our partnership concierges. This is an individual on our team that really is there to help answer the questions that you may have and figure out whether or not there's an opportunity for us to ever work together. But if that is not the case, if you're not interested in doing that, that's perfectly fine too. What I'd suggest to you, though, is do something different, right? Because what you're doing right now, it's not working, right? Otherwise, why would you have spent this amount of time watching this, right? You know, I'm a realist. Like, you're not going to dedicate, even if you're watching this on the replay and you're doing it at 2x speed, right? Like, it's still taking time. Like, we've been here for over an hour and a half, more than 90 minutes together. So you're not going to be doing that unless you were actually interested in getting different outcomes than you're currently getting. I mean, that's just the reality. And I want you to stop sending stupid checks to the IRS, because I hate those guys. Like, I do, with passion. Very vocal about it. You know that if you see my content. I want you to succeed. Hopefully, we can help you do that. And if at worst, all you do is subscribe so that you can watch content like this on an ongoing basis, at the very least do that, because that helps me, it helps the algorithm, it lets more people who potentially could benefit from what I share see it. So please hit subscribe, hit like, hit share, add comments, because at the end of the day, that goes through the process. Now, I'm not going to wrap up entirely. I'm not going to say goodbye yet, because I do know that there were some questions that happened during the session. They happened, I saw them scrolling by. They went by so quickly, though. So I'm going to ask my team if they wouldn't mind showing me some of the questions that may have come up so that I could try to answer them for you. Okay, I'm gonna absolutely mispronounce this name. Aditya. Hopefully I didn't butcher it too bad. Asks, would love your view on tax deduction strategy, including charity loans paired with max-funded IULs. I tend to get lumped in with people who hate insurance, because I comment on insurance a lot, because I again, you may not know this. When we do our reaction videos, we don't source those videos. They are sent into us by you, by the community, right? So I do not see those videos before we record, right? So what happens is my team hits record, I hit play, and I'm watching them. My team's filming me in an authentic reaction. Like, it's me watching it for the first time, then I put the phone down and I literally talk. There's no scripting. And oftentimes, you guys are sending me videos from people who are absolute insurance agents, right? And all they're doing is like hard selling insurance policies. And most of the time, they're selling policies designed in ways that I believe to be not really all that beneficial to those who are buying them, right? They're really beneficial to the insurance agent selling them because they're structured in such a way that results in that insurance agent getting an amazing commission, right? But again, I'm not saying all insurance agents are bad, and I'm not saying that all insurance policies are bad. I do believe that many insurance policy structures are overly complex, and therefore, in my opinion, many insurance agents don't truly understand them fully. And I can say without a doubt, many purchasers of those policies don't understand them fully. And Index Universal Life tends to be a policy type that is very complicated, has a lot of different fees and issues related inside those policies that many insurance agents don't truly understand. And again, the vast majority of actual insureds, individuals who actually purchase those life insurance policies, they definitely don't understand, right? And I can say that just because of the conversations I've had with individuals who've gone out and purchased those types of policies. So I tend not to like Index Universal Life. Doesn't mean it's a horrible tool as a blanket statement. I just believe that oftentimes that particular policy type is structured in ways that are not necessarily truly advantaging the person buying it, right? But I do believe insurance is an amazing tool just for the right projects, right? So just like you wouldn't use a hammer to fix a broken window, you don't necessarily use insurance as an investment alternative, because it's not. It is a risk mitigation tool. Now, many insurance policies have additional ancillary benefits or features that are of interest, like taking policy loans. But again, a policy loan is not you accessing the cash value of the policy. It's you getting a loan from the insurance company, and the insurance company is essentially encumbering that policy, right? They're essentially letting you go through the process of collateralizing the policy, and they're giving you the loan. Now, again, still an interesting concept, because it affords the opportunity to consider things like the creation of a quasi-family bank, and utilizing those policies in such a way to leverage things like charitable contributions, et cetera. So my take on this concept is that you want to really sit down and understand, is this approach the best approach given your facts and circumstances? Or is there something better that you could be doing given what your goals and objectives are? But I love the question. I know it's not a straightforward answer, which most people like yes or no. But the reality is sometimes it truly does depend. It depends on facts and circumstances. So I want to make sure I'm always transparent with you. Michael asks, are you seeing a lot of potential in AI to help automate these strategies? I am actually. I've been really trying my best to stay toward the cutting edge with regard to what's happening in the AI ecosystem. But the reality is it's evolving at a pace that is just not possible, at least not for me, right? It's constantly in this evolutionary stage. And there are many services now that are leveraging AI in such a way to enhance what otherwise taxpayers would be doing, right? I still believe that activity, that enhancement activity, is more in the doing stage of things, not in the strategy stage of things. Now, and the reason I say that is because so far in all of the different ecosystems we've been testing, there's still a significant amount of gap between the understanding of what the strategy potentially could be and the application of strategy to specific facts and circumstances of a respective client. But we're leveraging AI. I mean, we utilize AI as a tool. There are ways that we're constantly trying to increase our leverage of that tool, because our belief system is, just like any tool, if it can make it better for those that we serve, we want to leverage it, right? It would be really hard to change a tire without like a tire iron, right? Or at least a lug nut remover type of drill, right? You need those types of things with the right amount of torque and the right amount of like all of that, right? In order to get the tire off. The same thing happens with regard to strategies. You need the right type of tool in there, and certain tools like AI make it possible for you to be more efficient and effective, right? It is not yet a replacement. Let me say this though, again, because I'm a realist. The reality is AI is coming and it's changing the landscape for everyone. And if you are not cognizant of that, you're going to wake up one day and you're going to be like, oh my goodness, the world has changed and I missed it. Don't be that person, right? I read a paper recently over the course of the past just a few days, because someone shared it with me, and it was stipulating that only about 2% of the world population has been made aware of AI. Like, think about that statement I just made. Has been made aware of it. I mean, they're not even aware that AI exists. 98% of the population. Now, the reality is the 2% that are aware of it, even that is a very, very teeny tiny fraction of that 2% is actually doing anything with it, right? But the whole AI ecosystem is changing. Like, it is the fastest area of development that exists. I read something recently that if you look at the Magnificent Seven, right, the companies that are investing heavily in AI, like you're talking about the NVIDIAs and all of that ecosystem, in Q2 they spent half a trillion, $500 billion on data centers. Like, that's historical numbers, right? Like, if you were trying to compare that spending to anything else that has ever happened in history, the only thing that I think probably comes close is what the railroad industry did, like with the development of like railroads, like the capital expenditure to infrastructure. $500 billion in one quarter, and the pace of that investing is increasing and advancing significantly. We're already into Q3, and it is likely that Q3 spending will outpace Q2, right? This is something that is all in, guys, and no matter how much I wish it weren't so, this is happening, right? This is happening, and it is significantly going to change the landscape of the entire world. So if you're not taking advantage of strategies to reduce your taxable income today, to keep more of every single dollar you make so that you can invest those dollars in wealth creation assets, to set yourself up to withstand the economic challenges that are absolutely going to be a byproduct of this activity, because it's going to happen. There's you'd have to be pretty dense not to realize that there's going to be a lot of upheaval in the next 2 to 5 years. Like, if you're not doing what you can do now, like, shame on you. Shame on you. I'm doing it. I've been creating wealth now for 3 decades. Now, granted, a lot of my wealth creation has happened over the course of the past 10 to 15 years, but I've been working steadily at creating generational wealth, right? Not just for me, but for my family. Because the reality is I have 2 little ones. Like my son Ryan is 11, my daughter Victoria is 9. She's going to be 10 in September. They're inheriting a world that's completely different than the world we grew up in, guys. And I need to position them for being able to survive it, right? Okay, question number 3. Matt Thompson asks, how much can you pay your kids without giving them a W-2? I have a multi-member LLC just starting this year. Now, there's a lot of rules when it comes to hiring your kids. Inside of our ecosystem, I have an entire masterclass on this, which is multiple hours long. And because there's just a lot of rules with regard to hiring your kids. The first major rule is that the employer of the minor child can only be a parent of the minor child. So if you have a multi-member LLC that has anyone else that is not a parent, well, then you can't employ your kids in that tax-free ecosystem that I shared. You would actually have to create the creation of a separate company. I call them family management companies. Family management company number 1, specifically in our ecosystem, is designed in the right way so that you can hire minor children and have that company be the thing that services any and all other businesses within your enterprise. And then, again, shift money from your tax bracket to your minor child's. Now, federally, you can pay your kids up to $15,000 per year and not have any federal income tax, not have any federal Social Security and Medicare taxes. Now, each state, though, is going to have its own rules. So you'd have to take a look at your respective state because not every state mirrors the federal standard deduction. So you don't want to look at that. The other thing you have to look at is what are the rules within your state with regard to the type of work that is permitted at different ages for your minor child. Now, don't get misled in the belief that you can't hire your minor kids because a family business can always hire a minor child. It's just the type of work has to be appropriate for age, right? Like you wouldn't hire your 3-year-old to drive a delivery truck for you, right? It has to be age appropriate. It also has to be safety, and there has to be certain times of the day that they're permitted to work. There may be limitations with regard to what work activity is permissible during the school year versus on break times, like summer break as an example. Like these are things that you want to talk with your professional about. But Matt, this is an excellent question because it means that you're in the right mindset, that you're trying to figure out ways to keep more of the dollars that you're working hard to create, right? And income shifting is an amazing strategy. I'm happy for you. Happy for you. Andrea Bell asks, does the Roth approach win if you are in a state with very high income tax? Absolutely it does. And the reason I say that is because currently you are in a state with high income tax. The reality of life is that as you age, you may choose to relocate to a state that does not. I currently reside full-time in Florida, a state that has no state income tax. But even if I stayed in a state with high income tax, it's not magic, it's just math. Do the math. The creation of tax-free money compounded over multiple years, hopefully decades, is significantly beneficial in your wealth creation journey. So I am absolutely a huge advocate of the Roth aspect of everything, whether we're talking about Roth IRAs, Roth 401ks, the mega backdoor Roth strategy where you combine a Roth 401k, maybe a solo K if you're a business owner, and a backdoor Roth IRA. When you combine those two together, you get nearly $80,000 each. If you're a married couple filing jointly, $160,000 potentially into a tax-free bucket forever. And allow it to compound and grow. And like, guys, this is just an amazing strategy. So if you're not leveraging it, you're not sitting down with a professional who can give you guidance on how to do this the right way, again, shame on you. Shame on you. But Andrea, I know you're gonna reach out to someone who knows what they're doing, and you're gonna get this locked in for yourself. Mark Klonik asks, so can I do this Roth IRA strategy for myself if I'm an employee of my company? Yes. So here's the deal. When you own your own company, an S Corp, there's potential for you to institute your own employee benefit structure, which could include a 401k as an example. Now, if you have other employees, there may be reasons why you don't want to do that. But if it's just you, like a solopreneur situation, or maybe you and your spouse are employed by your company, but you have no other full-time employees, everyone else is an independent contractor or a part-time employee, well, then you can leverage something called a solo K, right, or a 401k with no other participants, and leverage that in the Roth aspect of things. But even regardless of that, if you don't have a 401k, you could still do a Roth IRA, right? And even if your income puts you beyond the ability to contribute annually into a Roth IRA, you can contribute after tax into a traditional IRA and the next day convert it to a Roth, right? So at the very least, you get to put $7,000 plus into a Roth IRA every single year. Both you, and if you are married, your spouse. And if you have kids who you're employing, which I was just talking about in the other question, if you're employing your children, you can set up a Roth for them as well. You just need earned income in order to contribute into an IRA, whether we're talking about traditional or Roth. You need earned income. Now, again, if your income is too high to contribute into the Roth directly, you just contribute after tax into an IRA, and the next day you convert that to a Roth. Like we help clients do this all the time, right? Like one of the companies I own is a private wealth management firm. So we set this stuff up for our clients all the time. Every week we're doing this stuff. We're doing these activities. Great question, though. Great question. Doric asks, you talk about generational wealth. When you die and your kid inherits your investment account, is there a step up in your basis? Yes, as long as you owned it when you passed. So step up is available for individuals who inherit an asset. If you gift that asset to them during your lifetime, whether if you're gifting it directly to them or if you're putting it into an irrevocable trust, that's considered to be a gift as well. If you gift it during your lifetime, the gift brings your basis with it. But if they inherit your assets, either through intestacy law, meaning let's say you don't have a will, your state drafts one for you, it's called dying intestate. If you have a will and the will says they get the asset, or if you put it into a revocable trust, all of those channels provide a step up in basis when you pass away, which means that the value at the time of death now becomes their basis, which means if they immediately sold it, there would be no capital gains tax, right? Because it would be sold at the value at the time of death. And even if it went up in value and they sold it a little bit after that, they're only going to pay capital gains on the difference between the value at death and whatever they sell it at, not what you originally purchased for, because that basis steps up to the value at date of death. Awesome question, Doric. Love it. Andres, you interacted a lot during the session, so thank you for that. So I'm glad I'm getting to answer a question that you asked. So Andres asks, HSA sounds fantastic, but it scares me for the sole reason of the high deductible. I think it makes a lot of sense for younger, healthy people. I am almost 40 with 2 kids under 5. What do you think? That is an excellent question, right? It's an excellent question. The reason for it is because it tells me you're actually thinking about your own facts and circumstance, right? Remember, I said that all of this depends on facts and circumstances and fine-tuning strategy based on them. And I absolutely agree. Younger individuals who are rather healthy, who are not tapping into insurance on a regular basis, high deductible plans are a home run for them because they're not really ever really tapping into them. They're not going to the doctor often, and they're not necessarily coming out of pocket. The HSA could still make sense if you get involved in a side hustle, Andres. And the reason for that is I have an entire other aspect or strategy that we leverage in addition to the HSA called a health reimbursement plan, right? That reimbursement strategy gives us the ability to engage in additional tax savings because we get to reimburse ourselves for all of our out-of-pocket expenses, including deductibles, right? We get tax savings for that out-of-pocket, and we still contribute into that HSA. Now, again, that may not make sense in your circumstance. We'd have to evaluate that. We'd have to take a look at the entirety of the facts and circumstances and determine which particular strategies make sense and how we could potentially complement strategies together that, but for the complement, strategy A wouldn't work on its own. But when you combine strategy A with strategy B, together they make sense. And in what you're describing, that may be the case for you, right? That may be the case for you. But I love the question because it shows me that you're thinking about your own facts and circumstances, and you're trying to figure out how can we potentially apply this to what's going on. Now, I've really enjoyed our time together. We spent almost 2 hours together in this session. And if you've been here the entire time, I just want to say thank you. If you've only watched segments, maybe you're here just at the very end, this live session, I'm sure is going to be recorded, or has been recorded, and my team will post it to our YouTube channel. So once it's posted there, please share it with as many other individuals that you think could get value from it. Like if you're a high-income W-2 professional, like share it with your colleagues. Because if we can help enough individuals become amazing stewards of wealth, Washington, D.C. loses and our local communities benefit. Because what I know to be true is that the vast majority of individuals who do well in life and are able to keep more of their own dollars, they benefit the people and the causes that they care about. They benefit employees that they have in their side hustles. They benefit their customers that they serve. They benefit their local community, right? That is how we change society for the better. And I'm hoping that you want to join me in this journey. If you got value, I appreciate it. If you've been here, I appreciate that. The interaction that we've had today, I've appreciated that. And if you want to learn more about how we may be a fit, be sure to click the link. And again, if this is in the replay, it's going to be in the description below. Otherwise, I wish you well in your journey. Be well. Bye for now.